Thanks for joining us for an update on financial markets and the economy. We will reflect on the happenings of 2023 and discuss some of the more interesting current economic and market conditions and their possible implications for investors. Matt, let's dive in.
All right, sounds good. Yeah, thanks everyone for joining. All right, so I wanted to start with looking back at 2023 on the whole. Obviously, we've been doing these at a quarterly cadence, but thought kind of widening out the window to the full year would be beneficial in looking back here. So for 2023, we had, broadly speaking, a very strong year for equity markets, a big bounce back from what was a challenging year, to say the least, in 2022. So we can see the S&P 500, so using that as a barometer for U.S. stocks, although we'll get into the perhaps poor barometer that it has been at times, was up about a little over 24% last year. Developing markets, represented by the MSCI EAFE, again, that's predominantly Europe, Japan, Australia, countries like that, was up about 15%, and then emerging markets were up 7%. So U.S. outperformance kind of continues to be the order of the day, and the emerging markets, kind of as an interesting aside, was really driven by actually weakness in China underneath the hood. Some of the emerging market economies and markets actually did pretty well, with even a handful outperforming the U.S. But because it is so disproportionately weighted to China, and China had a particularly poor year last year, that kind of dragged down the emerging markets performance. But again, the order of the day remains U.S. outperformance.
Matt, how did exchange rates play into those performance differentials, if at all?
Yeah, it was another kind of interesting year on that front as well. I mean, we saw some dollar weakness towards the tail end of the year, but not evenly distributed as it would ordinarily be, which perhaps was part of the reason for some of the nuance underneath the hood in emerging markets in particular, where we saw actually pretty strong currency markets relative to the dollar in like the Mexican peso, for example, even though we had broadly kind of a decent or strong backdrop for the US dollar, particularly relative to say the euro or the Japanese yen. Underneath the hood, it wasn't kind of correlations going to one. Again, we saw Mexico, I think the Brazilian real as another example, did decent underneath the hood. But broadly speaking, dollar strength or dollar holding up relatively well, I think was a primary driver of U.S. broad outperformance. So the next chart here, we've got kind of looking underneath the hood of U.S. markets, which we've done from time to time on these calls. So as I alluded to before, the S&P 500 may not be the best barometer of broad U.S. market health. And this chart really tries to unpack that a little bit. So again, we've got the S&P in the middle here, up 24% on the year. But the NASDAQ 100, the NASDAQ composite was up over 43%. And the reason for the divergence between those indices, as I think we've talked about in the past, was really what was recently dubbed the Magnificent Seven. So the seven largest constituents within the S&P 500 had outstanding performance last year. At points in time were attributable for upwards of 70-80% of the performance in the S&P 500 was coming from just those seven names. And as we've talked about, all the household names that everyone knows and clearly loves as well from a stock perspective. So companies like Apple and Microsoft, Amazon, Nvidia, etc., were really the catalyst for the strong performance, kind of broadly speaking, in the market. And you can see where the concentration in those stocks is even more pronounced in the NASDAQ. That led to even greater performance there. And then if we look, kind of another layer deeper at some kind of broader measures of economic strength, you can see on the backs of a very strong rally to end the year, we still had a decent year from other areas of the market. But at points in time, areas like small cap stocks represented by the Russell 2000, or an equally weighted measure of the S&P 500. So all the stocks get an equal weighting instead of the large concentration dynamic in the standard cap weighted S&P 500. All those were actually briefly negative on the year towards the end of October, and still, pretty significantly lagged those indexes with the heavier concentration to those big companies within it. And then thought it was important to just illustrate again here. We talked about this, I think, towards the beginning of last year, but this was really a mirror image of what we saw in 2022. So I think important to just call that out, where we actually saw those mega cap names, the growth names that have so dominated the market for really the past decade plus, kind of took it on the chin last year with the move higher in interest rates, where some of the historically less interest rate sensitive areas, more value oriented areas of the market actually held up relatively well last year. But we had saw a complete reversal of that in 2023 with those growth oriented names, the big companies really dominating last year. Kevin, anything you'd want to add there?
So some element of the outstanding performance this year was a bounce back from last year, it appears.
Yeah. So kind of the point to make here is the stuff that got disproportionately hurt the most in 2022 saw the most significant gains in 2023. Right, moving ahead here. So switching gears to the bond market here. Interesting year, as we'll touch on in the next slide. Kind of a lot of volatility in fixed income markets, echoing 2022. But actually ended up being a halfway decent year for bonds, bouncing back a little bit from the historic losses that we saw last year. And all the volatility we saw didn't really actually yield much net movement on the interest rate side. But what we're looking at here, as we've shown in prior calls, is just kind of a breakdown of the various primary components of the bond market. So we've got corporate bonds or credit on one end of the spectrum, and then high quality U.S. Treasuries on the other end of the spectrum. And, as we've talked about before, really the volatility was coming from the interest rate side. The credit side wasn't the driver of risk or concerns within the market, as credit held up relatively well. It was really the volatility in interest rates that we've seen over the last 2 years. So as we saw interest rates decline into the end of the year on hopes of potentially a reversal in the interest rate posture of the Fed, and potentially seeing maybe even a few cuts this year, we saw interest rates fall at the longer end, which caused bond prices to rise and have a pretty decent rally into year end. But you can see on the chart here, credit, particularly high yield credit, actually held up well throughout the year and had a really solid year, up almost 13.5%. And then again, that volatility that we're seeing on the rate side is really being driven by what the Fed's been doing over the course of now going on the last 2 years or so, 18 months to 2 years, where they've continued to move rates higher. But we saw the pace of those increases really slow in 2023. We were at, call it 4.5% or so coming into 2023. We only saw an additional approximately 1% increase in the short end by the Fed. And then we continue to see a lot of volatility kind of further out the yield curve. But as I mentioned at the onset, we started and ended the year at the exact same place for the 10-year note, so kind of more intermediate or longer term bonds. And the 2-year Treasury actually saw a modest decline of about 18 basis points from the start of 2023 to year end. And that probably really responding to this anticipation of potential rate cuts from the Fed this year. We're still, one other thing to note here, we're still seeing this divergence in opinions from what the Fed's telling us they're going to do and what the market's hoping or anticipating they'll do, from the last kind of Fed release where we kind of really saw this rally sparked in the move lower in interest rates. The Fed's anticipating maybe 0.5% to 0.75% in cuts, so 50 to 75 basis points. The market's anticipating somewhere on the order of 150 basis points or 1.5% of cuts, so double where the Fed's at, which when we touch on the economic data and the inflation front, that might be where this divergence is, the source of this divergence is.
There's still no benefit to investors for tying up their money really over almost any period.
Yeah, so the short end is really still the place to be if you're trying to maximize and get the highest yields possible. Obviously, by the virtue or the potential benefit of going longer out is that you are locking in that prevailing interest rate for a longer period of time. And should the Fed move forward with those cuts, the first place to see that impact is that short end. Those short end rates are going to move lower in conjunction with those rate cuts. So the trade-off is that you're potentially locking in those rates, but no additional compensation for the risk there. And the next chart, or actually I'll skip ahead here to the yield curve side of the equation, where we're still seeing that inversion of the yield curve where longer term rates are trading below shorter term rates. Although we have made a good deal of progress since around July of last year towards starting to mitigate that impact slightly. You can see the 10s versus 2s spread is now negative 0.18%. So 2-year Treasury notes are trading just 18 basis points above where 10-year Treasuries are, but still not being compensated for that risk. And that whole time value of money thing is still upside down, inverted on its head here. Just scrolling back here real quick, just to touch on the last piece here. We talked about credit and the strong performance there. The backdrop remains very benign conditions on the credit environment. So similar to the duration side of the equation, where we're not being well compensated to take on additional interest rate risk, we're still pretty below average across all kind of measures of corporate bond risk, or the additional risk we're taking on by investing in riskier companies, particularly relative to risk-free treasuries. So that remains very, very subdued, very benign environments there where we're not being well compensated for any potential risk there, although the market seems to think there are no risks there with the no landing. We've gone from hard landing to soft landing to no landing now is seemingly the prevailing view of the markets on where the economy is heading. All right, so switching gears here to that economic front here. So thought it important to continue to highlight the inflation piece, as that's really, I think, in the driver's seat of the Fed's policy decisions here as to whether or not to cut interest rates. Although if it is in the driver's seat, we are still a far cry from their target. The target for the Fed is 2% inflation and sustaining at a 2% rate of inflation. And you can see all of the consumer measures here, the middle two charts, still have a 3 in front of it. So we're not, stubbornly above that 2% target that the Fed is trying to hit here, which does make the potential about face on policy action from them all the more interesting. And then the last thing wanted to highlight here that we mentioned last time, but thought maybe a graphical depiction might help here. All these things that you're seeing, the headlines you see in the news of inflation coming down, just to reiterate, that is the rate of change of inflation. So inflation is still increasing, just at a slower pace than, the summer of 22 when we were at 40-year highs in inflation. So if you as a consumer are not seeing this decline in inflation, that's because the cumulative effects are still very much in place. Prices have not gone down at all and are still increasing, again, albeit at a slower rate. But, I'm sure consumers are still kind of feeling that stress. So the counterintuitive headlines of inflation coming down versus what we're experienced, be it at the pump or at the grocery store, et cetera, those impacts are still firmly entrenched. Kevin, anything you want to add there?
Well, I suppose the only thing that would bring down the price index, the cost of groceries, etc., would be something called deflation. I'm just curious, what do you think? What are the conditions that would likely cause that? Something we hadn't seen in a long time.
Well, typically a recession, which the market seems to have glossed over as no longer a possibility. Obviously, very acute concerns in the midst of 2022, and again coming into 23, the probably the most anticipated recession that never came to pass, or at least thus far has not come to pass. But typically the rare occurrences where you actually do see a decline in prices corresponds with pretty poor or pretty dire economic growth. I mean, the last time I think we saw actual deflation, so not just the rate of change of inflation going down or below the 2% target, but actually negative on a year-on-year basis, was probably briefly in kind of the March, April of 2020 time frame. And then I think before that, the only other time period prior to that, well, I mean, there's been other instances, but the Great Financial Crisis was the other time period in which we saw actual outright deflation.
So bad news. Bad news is your grocery bill's up 150% since 2020. And the bad news is it might take a recession for that bill to actually come back down again. Yeah.
And likely, I mean, when we do experience deflation, it's not, it's on the order of 0.5%, 1%. So maybe we see a, 1% decline in the overall price level during really bad economic conditions. But, these prices are likely entrenched in the economy now. We're not going back to pre-COVID in terms of the price levels, absent something cataclysmic, really, on the order of kind of Great Depression type of demand decline.
Let's find something more cheery to talk about.
Well, on the next slide here, we've got GDP and unemployment, which still remain robust for the time being. Again, the much anticipated recession that never came to pass, or at least has not come to pass yet. We saw really strong growth for the third quarter GDP. We have yet to get the first read of Q4, the last quarter of last year's GDP yet. That'll be, I believe, towards the end of the month, and then there's a couple of revisions until we get the final numbers. But we're still just operating off of the third quarter numbers, which were very strong at 4.9%, and with the more recent employment data, unemployment remains very, very subdued as well at 3.7%. So I think the reasons that everyone anticipated this recession was that we saw a historic tightening cycle, which is normally the tool with which policymakers, or one of the primary tools with which policymakers try to slow economic growth when things are getting a little hot on the inflation side. And in spite of that historic tightening cycle, we're still seeing unemployment at very low levels, and economic growth remains pretty robust for the time being. So still challenging or puzzling, and particularly in light of the fact that a lot of the not hard data that has come out, but a lot of the kind of forward-looking and some of the survey or sentiment data has been pretty lackluster throughout 2023, and has been in pretty much a terminal state of deceleration since our growth peaked out in 2021. So these two measures, we haven't introduced these before, but the ISM is a survey indicator that a lot of people focus on as a potential kind of forward look as to where the economy is going. So this is surveys of people like CFOs within major corporations of the decisions they're going to be making within their companies over the course of the next 3, 6, 12 months, be it their anticipation of hiring or firing individuals, increasing or decreasing inventory, things of that nature. And it gets divided out into a manufacturing survey, so the kind of quote unquote real economy where there's heavy industrial activity, and then the services economy on the other side of the equation here. And for essentially all of 2023, readings below 50 on here indicate contraction. Readings above 50 indicate expansion. So for basically the entirety of 2023, the manufacturing side has been in a contractionary state, and really at levels that typically coincide with a recession. So for all intents and purposes, we kind of have seen a manufacturing recession underneath the hood of the economy. Obviously not seen in kind of the headline or aggregate level numbers of the economy. And then on the services side, that has remained in expansion territory. But you can see over the last couple months, the data did start to deteriorate a little bit again, and kind of just hanging on to the flat line there on the services side of the economy. So the forward-looking data still, doesn't look great. Now, that's not to say it can't, reaccelerate from here, but things haven't, materially improved from a kind of slowdown perspective. And the last, or Kevin, I guess anything you want to add there, things that might help clarify that better for clients?
I don't think so. Keep going ahead.
So the last slide I've got in here is a potential culprit for why that recession hasn't materialized yet. So for the full year 2023, the U.S. federal government looks to have added about $2 trillion to the debt. It ended up being about, I think, a $1.7 trillion fiscal deficit for the year. Some of the other increase in debt may have been related to debt ceiling and kind of some plumbing type of factors, but still on net, we added $2 trillion to the debt for just the calendar year of 2023. And that was actually a $300 billion increase from the year prior. So certainly this had an impact on the economy. Whether it was the sole reason why the recession didn't come to pass, anyone's guess, or kind of remains to be seen there. But that kind of quantum of new debt and increased deficit certainly exerted an impact and certainly helped to kind of buttress the economy from some of the slowing elsewhere, like in the manufacturing area that we talked about. So going forward for 2024, this is now what is being compared against for 2024's growth. So, really either one of two things have to happen. Either the federal government needs to increase the debt even more to make up for the slowing economy, or the private sector needs to kind of pick up the slack. Or else, we may actually start to see, we could potentially see that material slowdown in growth that has been anticipated, but has yet to come to pass. And obviously, with an election year, anything could happen, I suppose. But just wanted to note that was a really outsized expenditure from the government, particularly in a year where we were still in an economic recovery. Typically government spending increases into a recession to kind of ameliorate the impacts of the recession. But when the economy is still growing, it's not common to see $1.7 trillion fiscal deficits, as most people could probably imagine. So not ending on we're ending on a less than cheery note here, I suppose. So I don't know if you want to put a about face on the negative party here, but
well, I heard you talk about growth and unemployment figures remain relatively strong.
Yeah,
that's very meaningful. Some signs of slowdown in industry. And the interest rate levels have been rather stable for a bit now.
Yeah. I think another important thing to kind of note on the impacts in terms of the economy is, when we had really low interest rates, both consumers and corporations, many people did do a pretty good job of terming out their debt or, refinancing their debt at those lower interest rates. So the move in interest rates maybe hasn't impacted as many people as it ordinarily would have. And that could be another reason why we're still seeing, very strong economic activity, because a lot of people aren't impacted by it. If you refied your mortgage at 3%, what does it matter if, rates are now at 7.5%? It doesn't impact you in the same way. And same for a corporation if they, took on debt in 2020, 2021 when interest rates were much lower.
So quick recap of investor implications on the bond side of things. we talked about how short-term interest rates are still very attractive historically and relative to other interest rates. But it could be interesting to begin to look at, as you use the phrase, locking in some of the longer-term interest rates, which, although not as high, are a lot higher than they have been, and with some upside.
Mm-hmm.
And on the credit risk side of things, or the corporate bond default risk side of things, still not a lot of compensation for taking that risk. Any thoughts on how compelling it might be to either add or decrease exposure to the higher risk bonds that take on credit risk?
Yeah, so the interest rates are still attractive in absolute terms, just because of how high interest rates are from the Treasury side. So credit risk or credit spreads is the risk-free rate plus some additional compensation for the risk you're taking, and that changes over time. And as we said, that additional compensation is pretty low, but because the risk-free rates are so high, high yield bonds are still yielding on the order of, call it 8%, 8.5%. So from a historical perspective, pretty attractive. But again, that additional risk compensation isn't there. So, I mean, as we've kind of talked about internally, I think for clients, the best way to maybe look at that is as part of your risk bucket. Don't consider those high yield bonds as part of your safe money per se, but because those absolute returns are so high, I mean, 8.5% is relatively close to historical returns for equities. So, not bad as a, kind of relative trade to other risk assets potentially, but maybe just not within your safe money bucket of fixed income.
As we launch into what is sure to be an exciting election year, many investors, I've heard them say things like, well, it's an election year, so that the incumbent party is going to want to see a strong economy and maybe a strong stock market. From all the research and familiarity you've developed with markets over the years, have you drawn any useful insights about the correlations between election timeframes and markets, or anything that's useful to derive from these conditions?
Short answer would probably be no. Markets are dynamic in nature. I mean, you can look back at the historical analog that, election years do tend to be, pretty decent for market returns. But, you could have said that in 2020 and you would have been right for kind of the totality of the year, but got off to a pretty rocky start in that February, March time period. So if you were kind of banking on that, you may have been white knuckling it a little bit at the bottom of the market there. And I think, as always, because markets are dynamic, the conditional factors I think matter just as much as those historical analogs. So, and all the conditional factors are some pretty unprecedented elements. We just saw a 40-year high in inflation. We've seen this massive blowout in the fiscal deficit in an expansionary time period. So there's a lot of variables at play here, and all that to say, I think just betting on that simple, well, historically speaking, we've seen in election years, markets tend to trend higher. I wouldn't bet the farm on that necessarily. I think in keeping, I think sticking with one's, I don't think it's a reason to deviate from one's plan by any means, but I certainly wouldn't be making any bets one way or another based upon, election years are usually pretty strong for markets.
I'll just add to that. As much as it's fun to think about and speculate about the winning or dominating a political party, unfortunately, has not provided any strong correlation, evidence, or otherwise about how that party may impact markets relative to the other. And in my conversations with folks, their concerns are very consistently about the opposing party and what will happen upon their victory And what's funny about that is those are like equal opposing forces in sentiment of investors.
Yes. Yeah, absolutely. Well, I mean, it's, I think that mere fact alone of this kind of rising feelings of, the counterparty, whatever that may happen to be for the individual, posing, an existential threat to the economy, the country, et cetera, et cetera. I think that alone probably could yield some fireworks around the markets and some volatility around the markets versus, the outcome being the determinant of it. I think our feelings around that outcome may be more the determinant than who actually ultimately wins potentially.
Well, we'll see how it plays out again this year. But from my experience, it's a lot of talk about the inevitable volatility associated with these things, and then it tends to look like any other market year in economics in retrospect. So, if anything, I would probably urge caution to not make extreme bets.
In either direction.
in either, yes, that's right, either direction. Well, Matt, thanks for the rundown of 2023 and the update on the more interesting current market measurements and dynamics. And we'll look forward to getting together again next quarter.
Yeah, sounds great. Thanks, everyone.
This is really for educational purposes only. If you have questions about your specific situation, please consult a professional. Thank you.